All right. Welcome to another episode of Tuesdays with Audi, and I am your host, Audi. Last week, we looked at a $100 portfolio in the stock market. And if you are aware that there were 4 out of 5 of those companies that paid a dividend, and the total return that we would get on this particular portfolio was about 3.67% return after 1 year, which is a good return of this $100 for this investment. In addition to that, we had 60%, which is $60 out of this $100 placed into ETFs. And the reason why I like ETFs, go ahead and visit this episode that's popping up on the screen at this moment, and you'll be able to see why. But the sense of safety that the ETF gave me in terms of protecting my investment, that's the reason why I decided to put as much money as possible into those 2 given ETFs. Not saying that the money is going to be safe, but it does help me in mitigating anxiety and going through the depression through loss of my potential investment into these companies. But then 40% was more riskier, even though I'm content with losing this $100. But however, even being content, there is still some sense of, okay, I still want to see this money tree that I've planted into these 5 stocks do well over time. And this week, we are going to compare this $100 portfolio in stocks versus $100 put into a bank account, preferably a savings account. As promised, today's topic is a bank account versus the stock market investment. Take out $1 to your pocket. Look at that dollar. I know, right? It doesn't buy a lot. It's just $1. But this $1 is the first seed of a money tree that you can plant and potentially watch it grow. There's an adage that says that the borrower is a slave to a lender. So if you lend this $1, then hopefully it can go ahead and make you more dollars in the long run. So let's put this $1 back away, even though we think it can't do much, but let's go ahead and see if we can plant a seed to a money tree and a potential financial vehicle. And in this case, we're gonna use traditional and conventional knowledge by looking at bank. So I know most of us, in terms of when it comes to safety of our investment, or our principal in this case, our parents love to tell us to go ahead and put our money in a savings account and leave it there so that it can generate some form of return through interest. So whenever you lend money out, which is what you are doing to the bank when you open a savings account and put your money in it, you are lending the bank your money. So this is what I mean by it potentially making you more money. So the first $1 is a freedom fighter. You send it out there and hopefully it brings you back more dollars. A bank is the most basic form of investment that we know to put our money in so that it can go and make us more dollars. But the thing is, most banks pay about a 0.01% to about 2% return on a savings account. So if we were to look at the rule of 72, how long will it take your money to double if you got a 2% return on the money that you put in a bank? Remember, the rule of 72 says that the 72 divided by the rate, in this case the rate is 2%, so we're going to do 72 divided by 2. Go ahead, drop in a comment and tell me how many years will it take for this $100 that we're going to start off with to double if we open up a savings account with it at a 2% return. And also hit the like button. For those who are new, thank you for stopping by and spending a few minutes of your day with me. For those who are returning, welcome back. I haven't seen you guys in a few weeks. I lied, it just want to be a week. But I haven't seen you guys since last week. So interest on a savings account can be calculated through simple interest or compound interest. Simple interest is simply interest, which is I, is equal to PRT. P is the principal, in this case it's going to be $100. Rate, let's go ahead and use 1%, which is going to be 1 over 100. And your time is going to be 1 year, which is going to be 1. So the rate of return that you will get on this $100 for after 1 year is $1. But if we do compound interest based on this $100 at a rate of 1% over a 1 year period, then this is the amount that you are going to get, seeing that most banks pay a quarterly interest on your savings account. But even with traditional knowledge, here are some things I did not know when it comes to banking. So let me know in the comments if you knew any of these particular things. 1, did you know some banks charge a monthly fee on their accounts? 2, did you know that there is a minimum requirement that you can have on your account to have this monthly fee waived from the bank charging you this monthly fee? 3, did you know that when you make a deposit to the bank, about 90% of that money is not left at the bank due to fractional reserve banking? At a 10% reserve, they only are required to keep 10% of the money you deposit to the bank at the bank for withdrawal purposes. 4, did you know that even though most of our parents tell us our money is safe in the bank, that most banks have an insurance up to a certain dollar amount on any given savings, checking, money, or certificate of deposit accounts? And in the Bahamas, it's under the Deposit Insurance Corporation, which protects your money in any of those four accounts up to $50,000 total and at one bank. And in the US, it's under the FDIC, which is the Federal Deposit Insurance Corporation, which protects any of those four accounts out of one bank up to $250,000. Even though our parents have told us that our money is safe in the bank, it's only up to a certain amount that the money is insured. So anything above that may not necessarily be safe. And did you know that banks create money out of thin air? So for example, let's just say you have John and you have a bank that's just opened up with no money, and John has $100. John goes to the bank and deposit his $100 at the bank. So Jane, who wants to start a business, wants a loan from the bank for $100. So since now the bank has $100, which John has deposited, Jane can borrow that $100 from the bank. So Jane goes and gets the loan for $100 and starts a small business, and she hires John to build in the things that she needs for her business. Jane pays John $100, then John goes back to the bank and deposits his $100 that he just made from providing a service to Jane. My question to you is that how much money does John have in his account with the bank? Drop it in the comment. Second question, how much money is in the bank? Drop it in the comment. And for those who got it, yes, the bank only has $100 and it's still that same $100 that John deposited initially in the bank, but John on his account has $200. So this brings us into the fact that based on the reserve percentage, a bank can lend up to a multiple of that number, and the bank can lend up to $1,000 based on this $100 that John has put into the bank. That's crazy, right? But yes, this is something I found completely ridiculous when I read this book called Sapiens by Yuval Noah Harari in the section called The Capitalist Creed. And I could not believe it, and it did not make any sense to me. This is what banks are allowed to do with money that is deposited at these given institutions. Let's look at the bank versus the stock market. So we know that there is a safety of our principal in the bank. However, in the stock market, your principal is never guaranteed to be safe because there's always fluctuation with the price of a share of a company, so you can increase or decrease. The bank pays you an interest. The stock market, you have two ways of actually increasing your investment: through dividend payments if you invest in dividend paying stocks, as well as through capital gains. Banks, you have to pay a tax on the interest that you receive on your money if you are in the US or certain countries, but you also have to pay a tax on your dividend payment as well as your capital gains if you do sell your companies for a given stock. When you put your money in the bank, it's just there sitting making you money. When you put your money in stocks, you are putting your money in a company, but you also are a shareholder. If you need your money from the bank, you can just go to the bank and withdraw it. In the stock market, you have to sell a company, and then after you sell it, you have to wait a few days for the money to become withdrawable from your account, and then you can actually use the money. But the thing is that we all need to use banks, and there's no way of getting around it. We use savings account in terms of emergency fund in case something goes wrong, as well as building wealth if we do need it in terms of the basic form of what we understand in terms of investing. You use a bank whether it's buying something online, having direct deposits sent from your job to your bank. You can also use them for paying bills, and you also use them for safety of principal in case you need somewhere to keep it, as long as you know it's not bleeding away in terms of the monthly fees. But after looking at the portfolio and also noticing what the returns are going to be on $100 in the stock market and the bank, which is a 3.67% in the stock market if we keep everything as it is, without necessarily looking at the $100 in terms of it increasing or decreasing, it's just based on dividend payment, as well as the interest payment that you will get from the bank on your $100 at the end of the year, which is about 1%, which is $1. So which one would you invest your money in? Would it be a bank account or putting money into stocks that pays dividends? Let me know in the comments. As I promised, my experience in terms of with a bank that I had a savings account with. So back in my senior year in undergrad, I had a few dollars, so I opened up a savings account and I put some money aside that I could potentially have for in case of emergency. And I made sure that that amount was the requirement that would alleviate the monthly fees. So after a year of having this money on this account, I was off to school for grad school, and then I came to check on this seed that I have planted in this particular bank to see how much it has grown after a year. So when I went to the bank back in the Bahamas, not gonna say what the name of the bank is, I went to get a transaction history of what was happening on my account, and I saw that there was some subtraction on my account. I asked her, tell her, well, what is this for? She's like, well, this is a service fee of the bank for having an account with the bank. I was like, but didn't I meet the minimum requirements to avoid the service fee? She said that the bank changed its terms and conditions, so therefore they have increased the minimum requirement to about, I think it was $2,000 at the time. And I didn't have $2,000 on my account. And I looked at her and I said, well, how many of your clients are able to meet this minimum requirement? And I said, didn't you see the survey that came out that more than 60% of Bahamians don't have over $1,000 saved? And she just looked at me and smiled. And I said, this is ridiculous. It's like, you guys are taking more money out of my account on a monthly basis than it is that the interest is paying this account. It's like over a certain amount of time, it's like you guys are gonna pretty much take all my money and I'm gonna be in the negative if you guys continue to take this monthly fee. And I was like, you know what? This makes no sense. How do I go about closing my account? And she said, well, it's gonna cost you a fee for you to close. I said, I don't even care about it. Just close my account because this makes no sense and I would like to take my money out of this bank. And so they closed my account, they charged me a fee for closing it, and I took my money over to another bank that had a lower minimum requirement to waive the fee for an account, and I opened an account with that bank. And after opening it with that bank, I must say, I've seen some pretty decent returns on my money, even though it wasn't a lot. But this was my first lesson in terms of putting seeds in fertile grounds, because if the seed are not on fertile grounds, then it's likely it's not going to grow and you are not going to see anything reap at the end of the day. Even though it wasn't a lot of return, but however, it helped me to realize the valuable lesson is that you always need to be aware of the fees in which are associated with your investments, because if you are not aware of those fees, it is likely going to be that poison that deteriorates you from actually making anything. In addition to that, fees are likely to increase, so be aware of those. Ask them first, find out what they are, and your interest rates in terms of what you are being paid are likely to decrease over time, while fees are likely to increase. So you always want to be aware of the fees that are associated with any form of investment before you put your money in that particular investment. And I hope you guys have enjoyed this episode. I thank you for stopping by and spending a few minutes of your day investing in yourself and the growth of this channel. Thank you so much, it's appreciated. And don't forget to hit the like button, subscribe, and share it with anyone that you feel as though would likely benefit from this. And seeing that we all need to have bank accounts and savings accounts, this will definitely help someone who is looking at putting their money in an account and being aware of some of the things that they need to look for as associated with fees when opening up an account with any given bank. Thank you for stopping by. Peace, love, enjoyment. Deuces, I'm Audi. See you all next week. Check out the episode on the $100 portfolio by clicking on this link. Also, the top 5 mistakes that investors make in the stock market.